Okay, let's get into it. We're talking about that one accounting topic that seems to give everyone a headache, home office and branch accounting. But what if I told you there's a way to not just pass the test, but to actually lock this knowledge in for good? I'm talking 3-year retention, so when you sit for the LCPA, this stuff is second nature. Let's do this.
So why is this so confusing? You've got one company, right? But suddenly, you're juggling 2 sets of books. It feels unnecessarily complicated. I get it. But here's the secret. It's not about memorizing 100 different journal entries. It's about understanding one simple core relationship. And once you see it, you can't unsee it.
So, forget cramming for your next quiz. We're playing the long game here. Think of this like building a house. We're going to pour a super solid foundation with the main concepts. Then we'll put up the walls by looking at how transactions are recorded. And finally, we'll put the roof on by creating the combined reports. Build it right once, and it'll stand strong for years, all the way to exam day.
So let's start with that foundation, the absolute core relationship of this entire topic. Everything, and I really mean everything, comes back to this one idea: mirror accounts.
Now, the textbook name for them is reciprocal accounts. But I want you to just think of them as a mirror. Seriously. When you look in a mirror and raise your right hand, your reflection raises its left. It's the same action, just from the opposite perspective. These accounts do the exact same thing. They track the same business events, and their balances should always be equal but opposite.
And here are the 2 stars of the show. On the home office's side, we have investment in branch. It's an asset, so it goes up with a debit. It represents the home office's claim on the branch. Now, look in the mirror. On the branch's books, we have home office current. This is an equity account, so it goes up with a credit. It represents the branch's accountability back to the home office. One's a debit, one's a credit. One's an asset, one's equity. They're perfect opposites.
All right, foundation's in place. Now let's watch this mirror relationship in action with some actual transactions. This is where we see the 2 parallel stories of the home office and the branch come to life.
Okay, here's your first big LECPA hack, so you're going to want to listen up. You do not need to memorize 2 separate journal entries for everything. That's a waste of brain space. All you have to do is master the logic of one side, because if you know what the home office is doing, you automatically know the mirror image of what the branch is doing. It's a 2-for-1 deal for your study time.
Let's make this real with an example. Say the home office sends 6,000 pesos worth of merch to the branch. Okay, what's happening on the home office's books? Well, their investment in the branch just went up, so they debit investment in branch for 6K. Simple. Now, what's the mirror image? The branch receives the goods, so they debit shipments from home office and credit their accountability account, home office current. See that? A debit to investment in branch on one side, a credit to home office current on the other. It's a perfect reflection, every single time.
To make this stick for good, let's call this the mirror rule. Just burn this into your brain. A debit to investment in branch on the home office books almost always means there's a corresponding credit to home office current on the branch books. And a credit on one side means a debit on the other. They are always in sync. If you ever see a problem where they don't match, ding, 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 you know there's a reconciling item you need to hunt down.
Okay, so we're good at recording their separate stories. But before we can mash everything together, we need to know how the branch actually did on its own. It's time to calculate the branch's net income. Think of it like the branch handing in its report card for the year.
And look, this is just a standard, straightforward income statement. Nothing tricky here. We've got sales of $1,940,000. For cost of goods sold, we take the shipments they received, which was $1.6 million, and subtract the inventory they had left, $260,000. That gives us a COGS of $1,340,000. Sales minus COGS is a gross profit of $600,000. Then we subtract their other expenses of $240,000, and boom, the branch net income is 360,000 pesos. We need this number for our final step.
All right, we've got the home office's story, we've got the branch's report card. Now it's time for the grand finale, creating the combined financial report. This is where we create that single, unified vision of the company that we show to the outside world, investors, banks, everybody. And here is the absolute #1 most important rule of combining everything. You must eliminate any and all transactions that happen between the home office and the branch. Why? Because it's just common sense. A company can't make a profit by selling something to itself. You can't owe money to yourself. For anyone outside the company, you're one entity, so all that internal back and forth is just noise that has to be filtered out.
And that quote really nails it. The whole point is to show the business as a single entity.
Put yourself in an investor's shoes for a second. Do you care that the home office ships some inventory to its own branch? Not really. What you care about is what the company as a whole sold to real paying customers. That's what this final step gives us, a true, clear picture of the company's performance.
So how do we actually do it? It's a simple checklist. First, you eliminate the internal transfers. So shipments to branch on one side cancels out shipments from home office on the other. They disappear. Next, those mirror accounts we worked so hard on, investment in branch and home office current, they're gone too. They did their job for internal tracking, but they have no place in the final report. Then, you just combine everything else. Add up the sales to outside customers from both the home office and the branch. Add up their purchases from outside suppliers. Combine all their other assets, liabilities, and expenses. And what's left is the true story of one unified company.
Okay, we have covered a lot. So before we wrap, let's lock this knowledge in. I want this to be fresh in your head, not just tomorrow, but 3 years from now. When you're walking into that LECPA exam room, this is your 3-year retention hack.
If you remember nothing else, remember these 3 things. 1. Mirrors. It's all about those 2 reciprocal accounts, investment in branch and home office current. Master their opposite relationship and you're halfway there. 2. Separate, then combine. Always figure out the branch's net income by itself first. Then you can combine the 2 stories for the outside world. And 3. Eliminate. The golden rule when you combine is to get rid of all the internal noise. A company can't owe itself money. Mirrors, separate, and combine, eliminate. That's the entire topic in a nutshell.
So I'll leave you with this question for your own study plan. Thinking about what we just went over, where is your personal bottleneck? Is it getting those separate journal entries right at the beginning? Or do you get stuck on that final step of combining and eliminating everything? Be honest with yourself. Whichever one it is, that's where you should focus your practice time first. Nail down your weak spot and the whole topic will click into place. You've totally got this.